Welcome back to Calm Investors. I am Ruth.
And I am Patrick. And Ruth, I have been thinking about something that I cannot shake.
Tell me.
The market has been going up for like 3 years straight, and I keep thinking, obviously it is going to keep going up, like it just feels so obvious that the trend will continue, and then I catch myself and think, wait, am I being an idiot? But it feels so right, Ruth, it feels so obvious.
I love that you caught yourself because that feeling, that absolute certainty that the trend will continue, is one of the most dangerous feelings in investing, and it has a name.
Let me guess, another bias?
Another bias. This one is called recency bias, and it is the tendency for your brain to give disproportionate weight to recent events. 3 good years feel like the market always goes up. 3 bad months feel like the market is broken forever. Your brain takes whatever has been happening recently and projects it into the infinite future.
So my brain is basically saying, the last 3 years were good, therefore the next 3 years will be good?
That is exactly what it is saying, and here is the thing: your brain is doing exactly what it evolved to do. Pattern recognition on the savannah. If you noticed that a certain watering hole had predators 3 days in a row, it was smart to avoid it on day 4. Recent patterns were reliable signals, but in financial markets, recent patterns are often terrible signals, because markets have a property that watering holes do not.
What property?
Mean reversion, extreme performance, good or bad, tends to move back toward the average over time. What goes up unusually fast often comes back down. What drops unusually hard often bounces back. The market does not trend in one direction forever. It oscillates around a long-term average, and 3 good years do not predict a 4th. In fact, the data shows something surprising. Years where the market was up more than 20% were followed by below-average returns, roughly half the time.
Wait, so after a really good year, there is basically a coin flip on whether the next year will be good?
Roughly, yes. And that is the opposite of what your gut tells you. Your gut says, it has been going up, so it will keep going up. The data says, it has been going up a lot. So the odds of a pullback are higher than you think. Your gut feeling is not just useless here. It is dangerous, because it feels so right.
So my gut feeling is basically useless?
Not useless, dangerous, because it feels so right. And that confidence, that feeling of certainty, brings us to the second half of today's episode, overconfidence.
Overconfidence. Like thinking you are better at investing than you actually are?
Exactly. And overconfidence has a very specific trigger: winning streaks, after a few good trades, or a few good years in the market. Your brain starts to believe that your success is skill, not luck, not a rising tide, lifting all boats. Skill, and that belief makes you trade more. Take bigger risks, concentrate your bets, because you think you have figured it out.
And I am guessing the data says that does not end well.
The data is brutal. Brad Barber and Terence Odian published a landmark study in 2000 called Trading is Hazardous to Your Wealth. They analyzed the trading records of over 60,000 households, and they found that the investors who traded the most frequently earned the lowest returns, not slightly lower, dramatically lower. The most active traders underperformed the market by over 6 percentage points per year.
6 percentage points. So if the market returned 10%, the most active traders earned 4.
Or less. And the reason is overconfidence. They believed they could predict which stocks would go up and which would go down. They believed they could time the market and every trade they made was an expression of that belief. But the data showed their predictions were no better than random. They were paying transaction costs and taxes to act on an illusion of skill.
An illusion of skill. That is a harsh way to put it.
It is Kahneman's phrase. Actually, he called it the illusion of skill, and it applies to professionals too, not just individual investors. Philip Tetlock studied expert forecasters for decades and found that their predictions about the economy and markets were barely better than random chance, barely better than a coin flip. Yet these experts appear on television with absolute confidence, and we believe them because confidence feels like competence.
Confidence feels like competence. That is a really important distinction.
It is, and there is a related trap that makes all of this worse. It is called the hot hand fallacy. The belief that a streak will continue in basketball. People believe a player who has made several shots in a row is more likely to make the next one. But statistically, that is not true. Each shot is independent, and in investing, the same applies. A fund that has beaten the market for 3 years is not more likely to beat it next year. In fact, Morningstar publishes data on this every year.
What does the Morningstar data show?
It shows that investors consistently pour money into last year's best-performing fund performance chasing. They look at the fund that returned 30% last year and think, that is the one I want. But last year's best-performing fund statistically underperforms the following year. The money flows in after the performance has already happened. It is recency bias and overconfidence working together. You see recent success, you assume it will continue, and you chase it, and the data shows it destroys returns.
So people are literally buying last year's winner and getting next year's loser.
Over and over again, Morningstar calls it the behavior gap in fund investing. The funds themselves do fine over time, but the investors in those funds earn less because they buy after the good years and sell after the bad years. The same pattern we talked about in episode 1. Buy high, sell low, driven by recency bias.
Okay, so recency bias makes me think the trend will continue. Overconfidence makes me think I can predict the future, and performance chasing makes me buy whatever did well last year. What is the defense?
The defense is base rates. Instead of using your recent experience as your reference point, use long-term historical averages. The S&P 500 has returned roughly 10% per year over the last 100 years. But in any given year, the actual return is almost never 10%. It swings wildly, up 25 one year, down 15 the next, up 30, down 5. The average is 10, but the path to that average is chaotic.
So the average is smooth, but the reality is messy.
Very messy, and recency bias makes you focus on the last few data points of that messy path and assume they represent the future base rates, say. Zoom out. Look at 50 years of data, not 3. Use 50-year averages, not 3-year trends, as your reference point for what is normal. When you do that, a 3-year bull market does not feel like a guarantee. It feels like one of many possible outcomes in a long, unpredictable journey.
50-year averages instead of 3-year trends. That is a completely different way of thinking about it.
It is, and it is uncomfortable because your brain wants certainty. It wants to believe the trend will continue. Base rates say, I do not know what will happen next year, but I know what has happened over 100 years, and I will use that as my guide.
All right, so what is the practice for this week?
Here is what I want you to do. Look up the S&P 500 returns for the last 50 years. A simple search will find this. Look at how wildly they vary year to year. Positive, 30, negative, 15, positive, 20, negative, 37. Now ask yourself, does your gut feeling about where the market is headed match this randomness? Then write down your market prediction for the next 12 months. Be specific. Will the market be up or down? By how much? Seal it in an envelope, put a date on it. Open it in a year.
The sealed envelope experiment. I love that because in a year, I will have proof of whether my gut was right or wrong.
And I can almost guarantee what you will find. Your prediction will be wrong. Not because you are bad at this, because nobody is good at this. And that realization, that humility, is worth more than any stock tip.
Humility as an investment strategy. I like it.
All right, let us lock in the key takeaways.
Let us do it.
Number 1. Your brain treats recent events as more important and more likely to continue than they actually are. 3 good years do not predict a fourth. Recency is not permanence. Number 2. Overconfidence grows after winning streaks and shrinks after losses. But your actual ability to predict markets has not changed at all. Confidence is not competence. Number 3. Investors who trade the most frequently earn the lowest returns. Overconfidence is expensive. The data on this is overwhelming. And number 4. The antidote is base rates. Use 50-year averages, not 3-year trends, as your reference point for what is normal. Let history, not your gut, guide your expectations.
And your homework, look up 50 years of S&P 500 returns. Write down your market prediction for the next 12 months. Seal it in an envelope. Open it in a year. Build humility about prediction.
If this episode made you question your certainty about where the market is headed, follow Calm Investors wherever you are listening. Share this with someone who needs to hear it.
Thanks for listening, everyone.
Stay calm, build wealth,